Hey, welcome back. Nowadays, despite a pretty significant crash a year ago, Alphabet stock is near the all-time high. However, even with a high price and as you are about to see, maybe even a high valuation, there might still be a ton of potential thanks especially to the buybacks. I'm sure most of you already know the business model pretty well, so I'm not going to go too much into detail. They split the revenue into two main categories: services, meaning ads, YouTube and so on, and cloud, as well as hedging and bets. Overall, they have a very good margin of 25 to 30%, which is amazing considering the company's size, and which can be an advantage in case competition heats up. In time, the company grew very well, from a free cash flow of around 20 billion back in 2016 to 18 to almost 80 billion today. A year ago, however, when the market was briefly hating them for various reasons, the price was almost half of what it is today, and this ratio became much more attractive. Even if it was in the low 20 area back then, we have to keep in mind that with these blue chip tech stocks, it's very rare to see them at what we normally call a cheap valuation. That's because ultimately the price is made by supply and demand, and with so much interest from funds and individual investors, it's kind of difficult not to sell if you cut the price a bit. However, we've seen what happens when even this interest is lost with Meta, who crashed almost 80% during the same time before recovering almost the entire loss. So I'd say this is kind of a double-edged safety net, because you either get less of a decrease thanks to the interest and the company buying back shares, or if things go badly and the interest is lost, then they go very bad. Now to get to the financials, Alphabet is in an excellent financial shape. They have current assets worth around 175 billion, of which about 120 billion is in cash. This money alone is enough to cover the company's total liabilities. Needless to say, this much money can offer a lot of opportunities. I mean, think about how many companies they can buy with it, but as you are about to see, they actually return most of what they make back to the shareholders. So the risk of such a company going bankrupt for financial reasons is very close to zero. You know, I think it's Peter Lynch, and honestly it's common sense, who said that it's very difficult for a company with no debt to go bankrupt, and this is the case with Google. Just in case you didn't know, there are three classes of Alphabet shares, A, B and C. Class A are the normal shares with normal voting rights, Class B are not publicly traded and offer 10 votes, and Class C have no voting power. Class C has actually been outperforming Class A by around 5 to 6% over the past 5 years, which is interesting because these are the shares that the company also planned to use for acquisitions and compensations and would get diluted in time. Since the founders already have around 51.5% of the voting rights thanks to Class B shares, I would go for Class A just in case one of them wants to increase their voting power, plus you pay less for a better thing, so it feels obvious to me. Alphabet doesn't pay a dividend, but they spend a ton of money on buybacks, authorizing a 70 billion program a year ago, which is the equivalent of a roughly 4% dividend, but buybacks are different. Now, we can't know the exact effect of these buybacks, but even if they add only 2 times the money spent to the market cap, in 5 years at the same level as today, this alone can be a 30-something% increase. Add growth, news, reports and so on, and you can see this even double in less than a decade. There are theories saying that buybacks can add around 5 times their value, meaning that they basically almost double the current market cap in half a decade, but each company is unique. Half a decade ago, the market cap was around 660 billion and they spent a total of 207 billion on buybacks. Technically, if you multiply them by 5 and sum it up, you get almost exactly at the current market cap, but we can't ignore the company's progress. By the way, Apple spends even more on buybacks, so if you want me to cover them, just let me know in the comments. Despite the company's massive size, there is still potential to grow, especially thanks to what they call bets. To be fair, bets is probably not the best term, but they give a very good idea of what they can get in return. Most of them are probably barely breaking even or even losing money, but if even one of them is doing exceptionally well, it can offset the others and return a long-term profit overall. Now, this is something that most of the big tech companies do. Think about Meta's VR or Instagram at some point, the Apple Watch, or even Google's AI. To be fair, the Gemini AI looks really incredible. I mean, if you thought ChatGPT is great, this is in another league. What's the potential, how much can they make from it, we can't know at this point, but I don't think this is just another hype. Now, a risk that I always mention when it comes to big tech other than competition is of course politics. At some point, and we've seen lawsuits and various ideas before, this type of company can be the target of some very unfriendly regulations. We can't know if this is going to happen, but keep in mind the risk of higher taxes, more lawsuits, fines, barriers in entering various industries, and I remember at some point even the idea of a forced split. As for a valuation, let's start with a free cash flow of around 75 billion, which is roughly what they can produce today. In a negative scenario, let's assume that the growth slows down, maybe due to competition or politics or even a recession, and they grow at only 3% per year, meaning that in half a decade they would produce around 87 billion. You can imagine that the market would be worried and that interest I was talking about earlier might not be here anymore if this is the case. Let's assume that the market is trading it at only 15 times that amount, which is relatively high but low for Google, meaning a market cap of 1.3 trillion and a stock price of 104. That would be a loss of around 30%. If you bought this a year ago below this level like I did, you probably don't have much to worry about, but even if you didn't, we have to take into account the effect of the buybacks. Including them, this is most likely a profit. In a second scenario, let's say they grow at 8% per year, which might be a bit conservative, but it's better to be safe than sorry. In half a decade, that's 110 billion, and if the market is trading them at 25 times that amount, that's a market cap of 2.75 trillion. That would be a stock price of roughly 221 for a profit of around 50%. Now, with the buybacks, assuming that they pay a total of around, let's say, half a trillion, and they add 2 times their value to the market cap, that would bring it to 3.75 trillion. That would be a stock price of around 301 for a profit of roughly 110%. However, if they add 5 times the value, which becomes more likely the less shares there are, we are looking at a market cap of 5.25 trillion. That would be a stock price of around 422 and a profit of around 190%. Now, in a better scenario, let's say that AI pays off and they keep growing at around 12%. I know it may look a bit low, but a compound annual growth rate of 12% for the company's size would be incredible, and they'd make around 132 billion per year. If the market is trading them at 40 times that amount like today, that by itself is a market cap of 5.28 trillion, similar to the previous example. So you get a stock price of around 425 and a 200% profit. Adding the buybacks, we get to a stock price between 505 and roughly 626 for a profit of 250 to 335%. Of course, this can be better or worse. Imagine how the market would react if they decide not to do buybacks anymore, for example, but even without them, this looks like a pretty rewarding investment. If you wanna see what about a month ago was pretty cheap in my opinion, at least from a dividend investing point of view, make sure to check out this video next. So overall this is not really the most attractive price for me, but there is still potential, especially thanks to the buybacks, which again could maybe even double the price in half a decade. But for someone that buys the same things monthly and doesn't necessarily have a lot of time to do research, this in my opinion is definitely one of the best options they could go for, especially if they focus on the long term. Now this is up to you. Do you want to pay a bit more than the fair value for a company that has a ton of potential and is probably going to dominate in AI and who knows what else in the future? The current price is not that attractive for me. I bought enough a year ago at an average below 90 I believe, and I probably wouldn't buy above, let's say, 110. I want and I can afford to be this conservative because again I am happy with my current position, and right now there are so many other companies at much more attractive prices. Overall, Alphabet is a very solid company with excellent financials, little to no debt and even a lot of potential. This is a financial fortress, and even if the growth slows down due to the growth in size, I believe they can still do better than the market, especially if bought at a good price. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.